Let's talk asset allocation. You've probably heard of VTI and chill, three fund portfolio, ideal stock bond ratios, how much international funds, whether you should or not add, small cap value stocks, micro stocks, should I overweight technology, what about real estate, crypto? The allocation of assets is made out to be so simple when you watch all these YouTube videos, right? But in reality, it is quite complex. And everyone's situation is going to be different, especially since we've made all these kind of investments during our accumulation phase. Today, I'll discuss my allocations and how and why I got there. I'm Vinny, and I reached financial independence at 45 and retired from my career in technology so I could play competitive sports, travel the world, spend more time with the family, and gain new experiences. Let me start by grounding on some common terminology. In layman terms, asset allocation is the type of assets you invest in, and asset location is the type of accounts you invest these assets in. Now, I have listed the most common types of assets that you would allocate to here. These are some. There are probably others, but these cover the most commonly used asset types. Now, asset location is what type of accounts these assets are in. There are broadly three types of categories. You have tax-free, tax-deferred, and taxable. Now, tax-free, you invest after-tax dollars. When you withdraw the money, you don't pay any income tax. Now, these are awesome, but they offer you very limited options due to the restrictions on how much you can contribute to them. Then there's tax-deferred. These are your IRAs, your 401ks, where you invest pre-tax dollars and allow that to grow. But you can only withdraw without penalties after you hit 59 and a half years old. Now, everything you withdraw from them is at regular income tax rates. I like these primarily for the free company matches. And then finally, there's taxable. These are your regular investment accounts or investments where you buy assets with after-tax money in either a brokerage account or just through bank transactions like real estate. You may pay taxes, but only on the gains. And if you've held the asset for more than a year, you pay very favorable tax rates on the gains. They can be either 0%, 15%, or 20% of the gains, depending on your income in that year. Now, in the previous video, I talked about how I invested my savings. I'll get a little more detailed here. So I maxed out tax-advantaged accounts, both tax-free and tax-deferred. Like HSA, about $7,000 a year, and the 401k, about $22,000 a year, plus the $10,000 that my employer would contribute. In these accounts, I would primarily invest in S&P 500. Most of these accounts offer some sort of S&P 500 investment option. And then I also set up a $600 automatic monthly deposit into my daughter's 529 account, which again was invested in the S&P 500. Now, my company also offered an ESPP program where employees could contribute up to $20,000 a year in their company stocks, which were bought for you at a 15% discount to the market price. I maxed that out as well, since the 15% discount was essentially free money. You could immediately sell that stock when you bought it for a free 15% gain, or you could hold on to it. I usually held on to it. I also had a brokerage account with Fidelity and also a rollover IRA account at Fidelity from my previous employers. Now, the rollover IRA was primarily invested in some sector ETFs and about 20% on some individual stocks. That was a big mistake. I should have just stuck to VTI or VOO. Now, this is what my investment process was. I would have about 3 months of expenses in my checking account at all times. And whatever excess of 3 months expenses, I would just transfer to my brokerage account and invest in VTI or VOO. Uh, to be honest, this wasn't a whole lot because after all the automatic investments into the HSA, 401k, ESPP, and 529, there wasn't a lot remaining to invest in my brokerage account. Maybe about $1,000 a month. Now we would get an annual bonus. This is what I used to make big investments, usually in real estate. I started off with single family investment homes, but I realized quickly that being a property manager for multiple single family homes would not scale. It took a considerable amount of time and it wasn't totally passive. So then I started using the bonuses to invest in multi-family syndication deals. Now, multi-family syndication deals are when there are these sponsors called general partners who buy these apartment complexes. And in about 5 years, they sell them at a profit. These general partners bring in limited partners to fund the acquisition of the property. During those 5 years, they generate profits from the rent minus the debt servicing costs and other expenses, and they distribute most of these profits to all the partners. Now, when the property is sold, you get anywhere from 50 to 70% return on your capital, apart from the 5 to 8% annual distributions from rent. Now, typically the minimum investment for these syndications was about $50,000. Now, I was nervous about putting large sums of money into these at the beginning. But by partnering with a close friend in a 50-50 partnership, it allowed us to get into these deals with just 50% of the minimum investment. And also, it provided each other a sounding board. So, we would critically analyze every opportunity and we would only invest if both of us were comfortable going forward. Now, this gave us confidence and these proved to be pretty lucrative as some of these investments doubled within 3 years. Now, off late with interest rates spiking, many of these syndications aren't doing well and annual distributions have been impacted. So if you're going this route, you got to do a little more research. But I really like the model because you do the due diligence for a couple days and then it's completely passive after you invest. There are also big tax advantages. There's something called bonus depreciation that these investments offer, so which significantly reduce your tax liabilities. But I'll get more into that on a future video on just tax saving strategies. Now, apart from salary and annual bonuses, a big part of my compensation was company equity. And that was given every year and vested over a 4-year period. So I would sell this equity as needed for some real estate investments, but I let most of this equity ride and remain in the company stock. So when I thought I hit my FIRE number in late 2021, I had 50% of my investable assets in my company stock, 25% in real estate, and the rest in other US equities and notes. Now, the equities were in broad market funds, sector ETFs, and some large cap stocks like Google, Amazon, Facebook, Apple, Microsoft, Berkshire Hathaway. Now, this is when the market had a big correction and the value of my company shares were down nearly 50% in 6 months. I quickly realized what a blunder it was having such a big part of my net worth in one company. And as soon as it started to recover a bit, I started selling and transferring the proceeds to my brokerage account. And I bought VTI or VOO. I finally have now brought down my allocation to my employer stock to 5%. But that journey took over 2 years because I didn't all sell it at one go. Now, one thing I do regret is following a dollar cost averaging method to reinvest these large sums of money into VTI and BOO. I should have just done lump sums. But you always try to time the market even if it's for a wee bit. Now, the market has gone up 50% in those last 2 years, but it does take a lot of guts to make one big investment. You're always trying to time it, right? Um, you're always thinking like if the market goes lower, then you can get in at a lower price because the market always seems too expensive. Now, since my last day of employment was in February 2024, my earned income for the year was fairly low. So I took advantage and did a little Roth conversion from my IRA. So here is my current asset allocation and asset location. As you can see, 51% is in broad US equities. And there are opportunities to increase that, especially with having 9% in money market. And this is like money that I still haven't invested in VTI, VOO after selling my company stocks. And then, and I still have the 5% of employer stocks, which I can convert to VTI and VOO down the road. So over the next 18 months, I want to reduce company stock, maybe reduce real estate a little bit, and the money market funds, and move them to a combination of VTI and promissory notes. I'm still in the process of simplification and getting to my ideal portfolio mix. I'm close, but there is still a little bit to go. Now, the promissory notes, dividends, and the distributions from the real estate cover a significant portion of my expenses. So, what I have to draw down from my portfolio is quite minimal. And essentially, I can use the cash or the money market component of my portfolio to fill any gaps between what fixed income I'm able to get to my living expenses. Now, what about bonds, you may ask? Well, I think for me, the real estate, money market funds, and the promissory notes combination do the same work as bonds typically do in a portfolio. They provide me fixed income and are not correlated to the stock market, providing diversity. Now, that was my asset allocation over time during my journey to FIRE, after FIRE, and adjustments I will be making to get to my ideal percentages. Now, after getting there, I will try to rebalance annually. There are several advantages to having real estate as part of the portfolio, especially from a tax standpoint. That's in your journey to FIRE. But there are some of the downsides, which are liquidity and the ability to rebalance every year. So it's not like you can just sell real estate like you could do with bonds in your brokerage account. Since I started these videos, I received several calls for advice from friends and acquaintances with various asset allocations and asset locations and the challenges that they are facing because of that. I did see a theme though. Many people who invested in real estate primarily are challenged with retiring early because all their investments are either in their 401k or IRA, which you cannot touch until 59 and a half without penalties, or in real estate, which is not liquid and doesn't generate enough cash flow to support their living expenses. This is where a balanced combination of asset allocation and asset location makes a big difference in your ability to retire. But the good news is that these are issues that can easily be fixed. It took me a couple years to move assets around to get closer to the allocations that I felt would allow me to retire. But if you are in a situation where your investment assets are a combination of tax-deferred accounts and illiquid assets, then over a couple years you could sell some of those illiquid assets and transfer the proceeds to a brokerage account. Yes, it's tempting to avoid taxes by doing a 1031 exchange and buying more real estate, but I think it's better to bite the bullet sometimes and just pay the long-term capital gains from the sale of these assets, especially if you're facing this liquidity challenge. Because I'd rather be financially independent and be able to retire earlier than just growing my wealth and postponing my date. Now, down the road, in maybe 10, 15 years, I plan to further simplify my situation by substituting the real estate completely and the promissory notes with just a mixture of equities and bonds. Now, why, you may ask? Well, I just want it to be simple for my family down the road if anything were to happen to me. At least that's what I'm thinking now. But who knows what 15 years in the future holds. So, what's your asset allocation and asset location strategy? If you like this content, please like, subscribe, and share. Also, please do comment on what you'd like to hear about in the future. Those comments and messages from y'all is what I use to determine what topics I should cover next. Until next time, be safe, invest, and savor the journey.